So here's a really interesting economic theory about the stock market going way higher really soon because of something called the Federal Reserve and negative interest rates, which the futures market has just recently priced in. It's almost as if the stock market is this piece of glass cup and the bottom floor here are interest rates. And it's almost like the Federal Reserve took some money and it was like, reality? Physics? No, we live in the Matrix. There is no spoon. But yeah, not even reality is making sense anymore, hence the really far-reaching coin trick analogy, which does not make sense, but come on, that was pretty good. If you were fooled, smash the like button, and if you weren't, comment down below for the YouTube algorithm, but whatever you do, don't play that back in slow motion, otherwise you'll know how it's done. But that's exactly what we're gonna talk about today to try to figure out where the markets are going, and I'm really excited. And here's the theory. The stock market is about to do something crazy and go way higher. So if you're an investor in the stock market like I am, then you stand to potentially make a lot of money. And that's a really interesting theory considering I just recently did a video that talks about the complete opposite of that, of why the stock market will fall. Because, you know, if it does, then I seem like a genius, and if it doesn't, I'm like, I got that covered too. In that specific video, I talked with a legend in the space of finance, Raoul Pal. In fact, his theory was that the whole economic system right now is on the brink of collapse because of what's called the insolvency crisis or the doom loop. In a nutshell, what that means is companies will not have enough money to pay down their debt because they're not actually making any money as a result of this economic shutdown, creating this infinite negative feedback loop affecting stock markets, bond markets, real estate markets, pension plans, and everything in between losing a ton of value from which there is no escape. It's almost like the financial equivalent of a real-life dark hole. Huh? I'm really sorry about that. That joke is way too far-fetched. Oh God, I've become the quintessential millennial. But on a serious note, Raoul Pal might have been very wrong about the stock market and it could be worth a lot more very soon. So which one is it, Andre? Do I invest in the stock market now or do I wait? And that's a great question because by now you've heard from Raoul Pal, a guy who's managed one of the largest hedge fund groups in the world, a guy who's worked for Goldman Sachs, and a guy who's an all-around brilliant college-educated finance guy. But now you're about to hear the opposite side of the story on why the stock market is about to go way higher from someone who's a college dropout who only makes marginally entertaining videos online, who's never had any formal investment training. So if you want to click away from the video, now's the time, and I wouldn't blame you. But if you're still here, thank you so much for sticking around, and let's begin. Hi everyone, my name is Andre Jick. Hope you had a wunderbar weekend. And let's talk about negative interest rates and what they mean exactly for the stock market, dividends, banks, student loans, real estate, and for people like you and I, the savers. Although, now that we have close to 33 million Americans unemployed, I'm gonna say most people right now aren't as much savers as they are survivors. So in an effort to keep the economy going, the Federal Reserve has plunged almost all interest rates to between 0% to 0.25%, cutting it dangerously close to negative interest rate territory. Now, we're not negative just yet, but to quote Bob Dylan, "The times, they are a-changin'." Because just recently, the futures market has just priced in the Federal Reserve's interest rate into the negative territory. What this means is that a lot of people have put their money on the fact that in the future, the Federal Reserve will be forced to have their interest rates turn negative. And if you're somebody who believes that the economy has to get worse before it gets better, then this is a very real possibility. So the million-dollar question then becomes, what do negative interest rates exactly mean for savers and investors? Like, let's say I'm investing here with Robinhood by buying dividend-paying stocks. What does this mean for our portfolios exactly? Well, just know that when the Federal Reserve announces, okay everyone, now interest rates are negative, what this means is that they're gonna penalize banks for holding on to all of this excess cash. And what that's supposed to do is it's supposed to encourage the banks to lend more money to us. And as a result, not only will we have access to all this free money, but we'll also be paid to take free money. Yeah, Howie, I'll take a few of those cases, please. That's a deal. The good news with all of this excess cash that we're going to be paid to basically borrow means that we are going to start buying everything from physical goods to real estate to stocks to even things we don't really need. This will also include major corporations who will use this opportunity to borrow a lot of this free money that the Federal Reserve's just making it rain. And then with all of this free money, what they'll end up doing is one of several things. They'll either use this money to just fund operating costs, or they'll reinvest this money back into the company to create better products, or they'll pay their shareholders back in the form of dividends, or they'll increase their dividends. Now, how high the market will go and how quickly it will get there will be largely reliant on just how negative that number will be and how long this will last. So the more negative that number is, the better off we will be. Not our kids or any future generations, but we'll be just fine. But typically, these things should not last for a long time. Usually they're just a quick burst to boost the economy, and then they come and they go. Now, the downside to having this negative interest rate policy is that it's gonna turn the stock market into one big magic trick. It's all gonna be just one giant illusion, because if companies are actually buying back their own stock rather than making real profits, what they'll do is actually just borrow money and repurchase their own stock. And that's just gonna drive their stock prices higher by removing the amount of stocks in circulation, because none of these companies will have learned their lesson from the situation that we're in now,
because they're dumb.
But seriously, if a company borrows money, they should never be allowed to buy back their own stock. Now and forever, you've heard it here first. Just kidding, you probably heard it here 300th. Okay, so that's the stock market in a nutshell, but what does this mean for the real estate market, or for people like me who are just ordinary people who just want to buy a house for themselves? Well, here in Vegas, the real estate prices are the highest they've ever been.
It doesn't make sense.
Well, in the case of negative interest rates, this is actually a very good thing for homebuyers, with the exception of a few key risks. And here's why. Because happiness can be found even in the darkest of times, if one only remembers to turn on the light. Because I forgot. I'm really sorry about that. Let's get back to the video. The good thing is obviously that you can get access to cheap and free money that you can use, but the bad news is that this will drive home prices way, way higher than they need to be. And this is especially true for the average home buyer who will rush out to get as big of a loan as possible because, hey, free money, right? Well, as soon as they do, they're gonna end up potentially borrowing more money than they can afford. And because in theory, negative interest rates should only last for a short amount of time, as soon as those home buyers get that house, they're gonna lose a lot of value on that home when those interest rates correct back to normal territory, and the reality of home prices will adjust to meet reality. Because remember, the higher the interest rate, the lower the home prices, and the lower the interest rate, the higher the home price is. So for someone like you and I, if we want to buy a house, we better make sure that however much we borrow is something that we can afford to pay back and not borrow more just because it's cheap free money that's going to pay us to borrow. Because let's say the worst was to happen and you go to buy a house and then 2 years later you lose your job or something else happens. Normally, you should be able to sell your house after buying it in a few years for some kind of a profit. But if you bought your house when it was easy and cheap to borrow money and house prices were inflated, well, a few years after that point, when interest rates will have hopefully corrected, your house price will have adjusted lower. So if you go to sell after 2 years of buying it, your house could have substantially lost a lot of value. And if none of that made any sense, just hit the J button on your keyboard to go back 10 seconds, rewatch it again, and it'll all make sense. I didn't know that about the J button. Yeah, and if you hit the K button, it'll pause the video, and if you hit the L button, it'll go forward 10 seconds. Amazing. Nothing but the finest educational value here. But now the most important question: how do negative interest rates affect the savers? Not necessarily investors, but ordinary people who just like to save money. And hopefully, if you've been watching my channel, you've been working on getting your savings rate to 50%. But here's how negative interest rates affect us. Now, because negative interest rates affect just how much banks are able to make on our deposits, they can potentially choose to stop loaning money altogether, because it doesn't make any financial sense for businesses to loan money to anybody at negative interest rates, because they still incur that risk. They still risk giving out their money to people who won't be able to pay them back, and even if they do, they won't make much money off of those loans anyway, so some of those banks will choose to just completely freeze letting people borrow their money, and that is really bad for the economy. And if you have a savings account with something like Ally Bank, which is supposed to be a high-yield savings account, you are no longer going to earn any more interest from those accounts, which means if you're relying on that for your stability or your income, then you're not going to make make any more money there, which means you'll be forced to take a higher risk in the stock market or elsewhere, or literally just be forced to hold on to cash. But speaking of cash, imagine you went to a car dealership because you heard cash is king and you want to use your cash to pay off the car. You have two choices. One, finance the car, or two, pay it off outright. Which one do you choose? Well, normally when interest rates are above zero, it makes sense to just buy the car outright because you have to pay interest on the money that you borrow. But during negative interest rate times, it actually makes more sense to buy the car through financing it. And in that case, you're actually paid money to borrow money. It's kind of crazy. And student loans? That's a thing of the past because now your loans are going to start paying you interest if you can figure out a way to restructure your loans into those negative interest rate loans for as long as they last. So the actual likelihood of this happening will largely be decided after we reopen the economy and put people back to work. So after the Democrats and the Republicans agree to come together and put whatever it is they want to put inside the CARES Act, whether it's the payroll credits or the tax deductions or the stimulus checks, whatever it is they end up deciding, after we put people back to work, and if the illness can calm down, then most likely we will not see anything like negative interest rates ever. But what are the actual odds of us going into negative interest rate territory? Because we've never had negative interest rates here in the US, according to my extensive Wikipedia knowledge. But President Donald Trump actually has expressed the fact that he wants us to experience negative interest rates. And can you guess why? Well, because he has a huge advantage in being able to have access to all of this money that pays him money to borrow. And with that money, he's gonna build more properties and more real estate, therefore making him even more rich than he already is. And that's actually pretty smart. And just so you understand, just because the futures market has priced in negative interest rates in the future does not mean or guarantee that we will actually see negative interest rates. So it's less of an indicator and more of a reminder that it's a possibility considering our economic conditions, because even if we did get negative interest rates, not every consumer will have access to all these phenomenal negative interest rates. That'll depend on our credit score and how safe or how risky these banks will think that we are. And it'll also depend on whether or not these banks will pass on these negative interest rates to us. But that's how it should work in theory. But if the illness situation gets worse as a result of putting people back to work too early, and we have another economic shutdown, which could very well happen, or we get a prolonged period of deflation, the opposite of inflation, which is when we just keep our money for ourselves and we don't want to spend any of it, we don't want to invest it because we're too afraid of what might happen to it. And in that case, that would create a lower demand, and lower demand creates lower prices, creating this negative feedback loop. And if that happens, then the likelihood of negative interest rates will have significantly increased, because by then the Fed will just have run out of ideas on how to stimulate the economy, and then they'll just leave the chat. And in that case, they'll just throw money at us. And at that point, it would make much more sense to just heavily short the dollar by getting yourself into debt, but only if you can get access to a good negative interest rate and if you can actually pay it off. But you know what you can get access to? You can get access to one free stock by creating an account with Webull, funding it $100, and get a free stock valued up to $1,400 in value. And you can get another free stock from Robinhood by creating your free account, and that's 2 free stocks you can get started with investing for absolutely free. But what I'm interested in the most is hearing your thoughts about which of these 2 theories you think will come true first. Do you think what Raoul Pal said is true about the economic doom loop and the insolvency crisis, and we'll see everything collapse? Or do you think the Fed will come in and save the day and just swoop in? Because I think the Fed will definitely save the day, and it will postpone the inevitable market correction. But when that'll happen is tomorrow. Just kidding. No one has any idea, and it's anybody's guess. Love you all. Thank you so much for watching the video. Enjoy the rest of your week, you lovely people. Follow me on Instagram, and I'll see you back here on Monday and Friday. And I hope you smash the like button for that trick I did in the beginning of the video, because I'm really proud of it. It took me way too many takes to do. And if you didn't, shame on you. Just kidding. I'll see you soon. Bye-bye. Well, in that case, you get the same interest rates that I did when I used to go on dates. Just kidding. My interest rates were always high. All I had to do was bust out a card trick. Bam. ABC. Always be closing. That's a lie. Yeah, that's a lie.